Hey guys, Mr. Travis Pavlik here, and we're going to talk about one of the absolute most important things that I can possibly say, the most value that I can provide, hopefully, the general state of the global economy. This week, the richest people, the most powerful, influential people in the world are at Davos, which is an economic forum of, basically the elites. And we're going to talk about, I'm going to show you clips from Ray Dalio, which is one of the most successful investors ever. And he's going to talk about the general economy. And then I'm going to frame it. What does this mean? And it gives special context to what cryptocurrency is doing right now and the future, looking out to 2020 and beyond. So here's Ray Dalio talking with CNBC. Let's see what he has to say. And he's asked about the general economy.
Let's particularly talk about the U.S., but I think it's generally true of the world. We are in this Goldilocks period right now in which we have had a beautiful deleveraging. The inflation isn't a problem. Growth is good. Everything is pretty good, with a big jolt of stimulation coming from the changes in tax laws and such. That is going to, at the part of the cycle, we're at the later part of the cycle. So if you look at the operating rates and you look at the GDP gap and measures, we're going to have a jolt of stimulation into that. And there's a lot of cash on the sidelines. I don't mean just investor cash. I think banks have a lot of cash. Corporations have a lot of cash. So we're going to be, I think, inundated with cash. I think that that's going to produce a lot of stimulation, and I think perhaps a market blow-off. In other words, we're in a situation where if you're holding cash, you're going to feel pretty stupid. And with that, everybody is going to become more deployed. Classically, this is late cycle behavior. And as you get that movement, then the interesting question is, how does the Federal Reserve react, or how do other central banks react? I think it's a very difficult thing to get monetary policy precise. Oh, that's why we have recessions, because you never can get it exactly right. I think it's particularly difficult to get it right now because of the fact that with interest rates so low, all assets trade at the present value of the future cash flows, so interest rates affect all assets. Because the duration of bonds and debt has lengthened, it just takes a little change in interest rates to have a bear market. And so the things that we look at are, in terms of tightening the monetary policy, will it be tighter than is discounted in the curve, right? We have a very small amount of tightening which is built into the curve. If it is greater and interest rates rise to greater, that can affect all asset prices.
But you're not necessarily talking about 4 moves instead of 3. You're talking about something a little greater than a quarter percentage point off, right?
It's all a matter of degree, right? We are entering that part of the cycle, right? That last part of the cycle. That last part of the cycle, I think, can last a year. But I would say when we come back here next year, probably when we're dealing it, the issue of the preciseness of monetary policy, the delicacy, is going to be a particular issue. So I think that you're going to get a reaction. I think that the Fed should think about how much of it is this jolt to stimulation, and they should let it go. That the notion of inflation worry, what is the problem with inflation? They're struggling to get it to 2%. All the central banks are struggling to get it to 2%. We're not going to probably even hit a core inflation rate of 2% because there are other things that are happening in the economy. So let it go, enjoy it, but probably we're entering the last segment.
But if this is the last leg, not only does the Fed have to get it right, you as the investor have to know when to be in and then clearly when to be out.
That's my game. Right. I mean, that's right. I got to know it.
Okay. All right. So some of you maybe don't quite understand what he's saying. I'm going to rephrase it. But what he's saying is he's using his knowledge of the economy, what's happening, and he's describing it as late stage. Basically he's describing what is happening and what the next steps are. So cash that's sitting on the sidelines, there's a cash infusion, people's psychology. He mentioned the investor psychology is that people will feel stupid if they're not taking on risk, buying assets basically, because all their other friends are going to get rich seemingly on paper, and they're going to need to put the money in, right? You see this especially with people who thought, oh, Trump's going to be bad for the economy, short the market or get out. They're feeling really stupid, and they're going to be the ones buying as well as corporations. This is a very good point, because mom and pops investing their money is one thing, but and it's all on the margins. So the next marginal buyer, who is it? Or is it a marginal seller? And he's saying that there's going to be a lot of big marginal buyers, institutions and banks, for instance, that are lending more money, taking on more risk. And he's talking about this as a late cycle stage, and I completely agree with it. Also, he's telling you the central banks are going to become a lot more important. Monetary policy. We print trillions of dollars. We have a party. The economy's back. Yay, hooray. From 2009, March 2009, I think, was the bottom. We had 8 years of Obama, a lot of skepticism as the market was climbing, and we still came to all-time highs in S&P 500, Dow Jones, whatever indices all around the world. We had the kind of Eurozone crisis and that kind of fracturing over there. And then within United States, he's not telling us this, but he's talked about it in other ways, but they kind of battle between the real economy, which is most Americans experience, and most Americans kind of the middle class falling out and almost becoming lower class, and more people on food stamps, etc., as the stock market's going up. So that's creating a lot of friction and leading to some of the policies and the political backdrop that we're seeing now in Trump's election. I thought it was interesting, that he's saying like, oh, you can't ever get monetary policy right, fiscal policy, the Federal Reserve, monetary policy, and that's what leads to recessions. Well, people like me are going to argue, and this is why I really got interested in the Federal Reserve and politics and Ron Paul, and then eventually it led to me finding cryptocurrencies. But I'm more of a laissez-faire, let the market decide, versus have some bureaucracy decide what money is going to be and let the banks get one rate and people do. I'm more of let the market decide what interest rate should be. So the other thing that I want to describe is he's saying tightening monetary policy. So the Federal Reserve, which controls interest rates, which only really banks get to lend at that low rate, and then it filters through the economy. So maybe the banks feeling their margins, because they're lending at a lower rate, maybe they're extending credit to you at a slightly lower rate on your credit card, but generally that's not really happening. Their margins are just increasing. So, the change in the curve. When he's talking about the curve, there are futures markets that trade in the future that give us a basic idea of the curve. And he's saying based on what the Federal Reserve does with monetary policy, or more importantly, investors' expectation of monetary policy, that sets the price. And what he's saying is that if that is upset, if the Federal Reserve gets too tight, if they say, things are getting overheated, the stocks are going up too much, we're seeing inflation change at a higher rate than we have in the past, we're concerned about that. Let's increase interest rates to drive down this kind of speculative mania, essentially, and let's be active and let's stop this. So that's what he's saying, is that that's not a good policy. That instead the Federal Reserve should let inflation go up a bit more, enjoy the rise, enjoy the boom. And what this means for most of you is that you want to be aware of what's happening. So what he is saying, and I agree with this, of studying economics for 10 plus years, is that you can, take more risk on during this time. He said in a previous interview it's going to be around 2 years. In this interview, I think he said it was 1 year, but there's going to be some sort of limited time frame when there's going to be a big boom. Also, the 2020 elections are going to be pivotal, because when we talk about, just like 2008 elections, it was at a changing time, right? We had the previous Bush regime and the economy collapsed. So then you bring in a new person in the form of Barack Obama. So that could be a possible inflection point, and there's a lot of different things at play here. But in the short term, it's extremely bullish. There's going to be marginal buyers coming in. In the longer term, you need to be looking for a change. So for me as a trader, I get to play the market long and short. For you, if you have a 401k, an IRA, some sort of investment account, or some side speculative kind of money that you're investing in, we're talking about all asset prices, right? So that means your house, if you have a mortgage, if you have rental properties, etc., it's time to kind of strategically plan for an exit, a reducing of risk, as we keep getting higher and higher. So you kind of have to set those thresholds for yourself and do some real planning, 5 years out. What do I need? How much risk can I take on? The most important point in all of this, if you understand that we're in a 30-40 year bond bubble, what he said was, if interest rise, 1%, I think he said, it'll be the worst bear market ever. And that sounds crazy, because the commentators were saying, oh wait, but I'm used to 5%, I'm used to 6%. So if it goes from 5 to 6%, and they're talking about not the Federal Reserve, but they're talking about what they can actually lend money at, maybe from their bank, that would still lead to a dramatic repricing of assets. So that small change, it might not matter to me, but it's already been factored in the price. When he says future cash flows, when you price cash flows, you use an interest rate. It's a calculation. If you're in finance, you can kind of do these calculations, and it leads to a dramatic marginal change in that asset price. So, a bunch of junk about the economic cycle. Understanding that bonds are in this incredible bubble. Literally there's negative interest rates. Stocks have been on a crazy run. So where do I hide out? Okay, real estate also, they're all connected, right? They're all asset prices. So where do I hide out? For the longest time, people have been hiding out in gold, silver, and physical assets. You go one step further and you go, hey, I want a bug out bag, I want land with water, I want ammunition, and I want guns, and I want health supplies in a zombie apocalypse. But the most important thing I can say here is that all of these bubbles that the financial landscape is painted with all across the world, China has their own problems with overuse of kind of like, they have almost, you think of a dictator, and they're saying build here, extend this much credit. They're over leveraged as well. That means that we're going to have such a deep recession. It's not even going to be a recession. It might be worse than, and I think it's going to be worse than the 2008 financial crisis. The difference is, I think Ray Dalio might say, okay, based on his calculation, there's not as much systemic risk because he knows what the banks have and their kind of cash position. So he probably thinks that the banks are in a better situation. But I think that there's probably more systemic risk because the banks are even more conglomerated together. There's less banks. They have the same kind of positions. So we'll see how extended they get during the next 1 to 2 years. Long story short, cryptocurrencies, the next generation of monetary phenomenon, are going to emerge in this time. The next 1 to 2 years, there's so much speculative excess that investors, clever investors, are going to look at what's the future 5 years, 10 years from now. There's going to be so much heat on the Federal Reserve, on all of these think tanks and the elites that plan the system, that cryptocurrencies and a different monetary system are going to emerge. It's so important. When we look at a global market capitalization of cryptocurrencies, we're at less than I could update you on the numbers, but it would change in 5 minutes. Around $500 billion. If we look at the NASDAQ 2000 bubble of just publicly traded companies, it doesn't include all the private companies or kind of the effects of real estate, etc. But that bubble was 6 trillion. Way back in 2000, inflation adjusted, it would be much more. Cryptocurrencies are the number one place for a speculative investor who's willing to risk it all. A strategy designed to take advantage of Pareto's principle of 80-20, where the biggest winners are going to massively outsize the kind of medium companies and the small companies. It's going to be more like 99-1, where there's a huge network effect. It's just like Facebook. There's not Friendster and MySpace and a whole bunch of, there is Twitter. There is other kind of social networks, niche, like LinkedIn is a social network. This is massively important. This is, a 20-minute video now, but basically cryptocurrencies are the next generation of finance. People, when the market crashes, when stocks crash again, they're not gonna want, the younger people are gonna say, look how stupid this is. I watched my parents live through the 2008 recession and all these elites made money, and that's not a system for me. I want a more fair, market-based system that relies on cryptography, on technology, on algorithms, on mathematics, that is a more fair, equitable system that doesn't just benefit central planners, big corporations, etc. So I hope that's clear. What do you think? Let me know in the comments below. My name is Travis Pavlik. Please consider subscribing, buy cryptos, and use a risk managed strategy. That's kind of the net result from all of this. Follow me on twitter.com/tpavlik, and thanks for your time.